welcome to Compliance for All's live webinar on Auditing Enterprise Risk Management. My name is Michael and I'll be your host for today's session, and on behalf of the Compliance for All team, I'd like to thank you all for being part of today's webinar session. Today's webinar is being presented by Denise Cicala. A few words about Denise before we start off today's session. Denise holds a CIA, CFE, a CCA, and PMP, and she's also the Executive Director at Auspicium. And she also has lectured and taught on the topic of construction audit in the past as well. And she also has led and participated in construction audits of major private and infrastructure projects, resulting in large recoveries for her clients. And she's also the author of the IAA Handbook, the Construction Audit Overview, Monitoring, and Auditing for Corporates. And we are honored to have Denise with us today to present today's webinar session. Ladies and gentlemen, before we start off today's webinar, I'd like to quickly outline today's program. This webinar is for a 60-minute duration. First, Denise will take you through today's webinar, highlighting the areas she would cover, and then share with you a presentation. And also would like to inform all our participants today that once part of today's teleconference, you've been placed on mute and would remain so until the Q&A begins. We have a couple of minutes at the end for your question and answers, but if you do come up with questions during the session, please post them in the Q&A panel or the chat messenger. And for any reason, if you do get logged out at today's session, please follow the same procedure to join in again. Now that we're all ready, I request Denise to take it from you. Denise?
Thank you, everyone, for joining tonight. Good morning, good afternoon, depending on where you are. Michael just gave a quick background as to who I am, and you may be wondering what that has to do with enterprise risk management. One of the reasons I've been involved with enterprise risk management is from my start in construction audit, I've now moved on to auditing capital improvement projects. In that role, I've run into a lot of executive managers who were looking to start enterprise risk management and didn't quite know where to start. They didn't know whether they should roll out parts of audit or what they should do, and I got heavily involved in helping executive management through my work. I do a lot of work overseas, and I worked with the Qatar Financial Authority about construction audit. As you can imagine, there's a lot of construction going on there. And they were working to roll out ERM as well, and we've done a lot of research for them. And through my time teaching and working with these executives, we've learned a lot about enterprise risk management and how it works in different organizations. I also speak for MIS, and through my work with MIS and as a beginning in audit, I started out in bank audit, and I teach bank fraud, and I've worked with a lot of banking executives who have ERM rolled out in their organization as well. So, I mean, I've dealt with ERM in many areas, though my specialty is construction audit. I've seen it a lot as well. I apologize for the sound on my end. I'm kind of getting rid of this flu that everybody has nowadays. So I encourage you, if I say something along the way where you just can't understand what I'm saying, please put a message in the chat window. I will not get offended. I'd rather you not try to figure it out than to me actually tell you what I said. So with that, some of the things we're going to talk about today. Hold on. How to measure the effectiveness of your enterprise risk management team. Audit's role from a hands-off approach. I've often been asked, well, since audit is the experts in risk, why can't they be my risk management team? It's very important that you look back at the way your organization is organized and ensure that that's not the case. Audit needs to audit ERM, and we'll go through it in the next couple slides as to why. They cannot be ERM. The reason being is they are not independent enough to be ERM. If we were going to go into the reasons of how audit can be, of what audit's role is in ERM, that would take us twice as long. So bear with me in understanding that audit and ERM are separate departments and they need to function separately. meeting the audit committee needs, meeting the board of directors needs, auditing while maintaining independence, and that's going to be the important part that we highlight. And that's why I said audit cannot be ERM, because from audit's role, two of the most important things we have to keep in mind is how do we be independent and how do we be objective. So we still have to go in and we have to audit ERM. Providing assurance on what risk management has come up with. So how do we do that? Well, do I need to audit ERM? Absolutely. They are one of the most key departments or key functions that you have. What is ERM and what are they doing? Well, what they're doing is they're determining every single risk and every single opportunity that comes your way and preparing you to face the challenges ahead. They are the ones to look at, symptoms that may be coming out. They're the ones to look at how you're doing amongst your competitors. They're the ones who understand all risks that you should be faced with. Yes, you can come up with risks from now until the next 50 years on any organization, but what they've learned is how to focus those risks, pick the critical risks, and go from there. If they're not doing their job, your department can be extremely vulnerable, or your corporation can be extremely vulnerable. It would be like the president declaring war without actually having an army in base. That's some of the key, they are that critical to you, so yes, they should be audited. Their success can be a crucial success. It can be the stepping stone that you need to really get ahead in the marketplace. But the same way, their failure can be catastrophic. Look at, for example, cars that get critical recalls and people will no longer drive them, or the reviews are so bad they will no longer use those. Those are failures that could have been predicted. And by ERM not doing their job, those companies are no longer present. Would your stakeholders expect you to? Yes, they would. Every time a company fails, what is the first word heard at the water cooler? Where was audit? Well, in this case, it should be where was ERM. But audit should be responsible to make sure that ERM was there and ERM was doing their job effectively and efficiently. ERM does not operate in a silo. They are not a standalone department. They are the watchdog for the organization. And as that watchdog, they're looking over the entire organization. Anything they do will affect other areas in the organization as well. So if they make a mistake, it is going to domino. So you want to make sure that they're not making a mistake. BP, WorldCom, they did not have an ERM department. What do we know about them now? You may be saying, well, what about BP? Remember the oil spill in Louisiana? Well, that was something that ERM should have been aware of. Yes, there is a risk that while we are doing this project, the pipelines may leak. And if that happens, there's going to be a catastrophic contamination of the waters around the project. What do I do to prevent it? What do I do to control it? Then there's the other side of the argument. Why shouldn't I audit ERM? Well, a lot of ERM experts and a lot of ERM members have egos attached to them. And I'm not saying that as a bad thing. We want them to have egos. They're in a very important position. But the egos that they're presented with is that they've been schooled by a different society than the IIA, and therefore they are the experts, and audit is not significant enough to audit us. You will learn how that ego and that attitude can be extremely dangerous to an organization throughout the next 50 minutes. For that matter, those egos sometimes get in the way, and ERM is reluctant to let audit look at what they're doing. Well, let me play devil's advocate for you for a second. As an auditor, and I've seen it before, especially when I was in bank audit, you go up to an area and you say, well, I'm going to audit you. We're not ready for you yet. It's our critical period. Go somewhere else, audit them, and then come back. I never accepted that as an excuse. To me, audit should come in at the appropriate time, depending on the audit life cycle and depending on the risk score of that individual department. We don't want you to audit us. No department wants to be audited. So that excuse in and of itself just doesn't hold water for me. Audit must stand firm on this. They must insist that an audit be done. Audit is the eyes and ears of the board, and the board is making decisions based on the work of ERM. They're relying on the fact that audit has looked at them and the information they're getting to make a decision is one that should be taken. The results of the audit will help set the tone for other audits. Listen, you may not want me coming in to do your audit now, but I need to. We audited ERM, we can audit you. But some of the risks that you discover during ERM are going to help you with your audits of other areas. And you want to make sure that ERM is not working in a silo, like I said before. You want to make sure that they've broken out and that they are reaching all areas of the organization fairly and correctly. The board of directors sees ERM as they have to take a material front line for all mission critical risks. They look at operational risks, they look at board oversight, and they're doing strategic planning. They're looking at operational risk even though they're not in charge of day-to-day operations. Board of directors is more focused on strategic planning. You can't do strategic planning without looking at the operational risks. For example, when we do capital projects, one of the things we look at is the decision-making process. Yes, the company is doing a project now. Should they have even started it to begin with? How did they come up and make an informed decision as to the risks involved in doing the project or not doing the project? How did they measure the project against operational risks to decide which project should be done? Because they're not overseeing day-to-day operations, well, guess what? The auditors know operational risk. They've done the audits. They know what department is weak, what department is strong. They know what resources all the departments have. They know where the control weaknesses are. The board of directors is looking at auditors to help them make that decision. And they want it done in a structured way. They don't want to go up to an auditor and go, hey, what do you think? Auditors aren't paid to think. They're paid to test. They're paid to verify. They're paid to reconcile. Measure how effective your ERM team is. What should your ERM team be doing? Well, that's the first question you need to ask yourself. How can I come up with an audit plan if I don't know what they're supposed to be doing? Well, I'll tell you what they're supposed to be doing. They're supposed to be looking at the organization and look at any risks that may come their way. This is not a one-time thing. They are supposed to be looking at risk on a day-to-day basis and see any new and emerging risks, or to see where risks that used to be docile or dormant are now rising up and should be considered. Our risk basis changes on a daily basis. Why? Because we work in a competitive workforce. Our competitors are constantly changing. Our consumers are constantly changing. We have to change with them, or else we'll be left behind. So what should ERM be doing? They should be looking at these risks. And they need to report the risks. If they're not reporting what they're finding, what good is it? They need to look at the residual risk. What risks couldn't they come up with an answer to? They need to look at any estimates or predictions that the company made. see where there are variances and figure out why there were variances. Why couldn't the company come up with an accurate answer as to what would happen in this situation? Well, here's the factors we considered. By the way, when it happened, here was an additional factor we never looked at. Why wasn't it looked at? If fraud occurred, why wasn't it considered? Is fraud a risk in an organization? Of course it is. Why did it happen? We know that fraud exists. We know we work in a controlled structure. If we work in a perfectly controlled structure, fraud can't happen. Well, if it happened, why did it happen? Why did return on investment not happen the way we thought? Why did stockbrokers who are working for a bank not have the market return that we thought? Yes, there's risk out there. There's market risk. There's stockbroker risk. There's volatility in the industry. But we should still be able to reasonably predict what will happen and how to minimize our losses. How do we come up with a better estimate next time so we can work with it? Are there any unforeseen risks that are now emerging because of this? Well, when BP had the oil disaster, yes, there were unforeseen risks. Now they had a greater reputational risk because people were watching them to make sure that everything happened smoothly the next time. Is reporting being done in a timely manner? And is it being reported to the right party? We'll go through a couple more slides and you'll see what they should be reporting and to who. Are they being monitored? Are adjustments being made to the risk register? Again, the risk register should be changing on a daily basis. And do they have a library? Even though risks change on a daily basis, some of the answers are still the same. And sometimes we repeat where we were on certain risks. Having a library helps them become more effective so that if a solution worked before, it'll work again. Now, the ERM library is also something that should be distributed on an organizational basis so that if you're working in a back office, you have access to it. You know what risks are emerging that you as a department need to look out for. The ERM library is a common knowledge database that, again, all functions can pull from. Whether it's a simple function such as janitorial to the most top-level executive function, everyone should be able to look at that and pull from it. There's no reason why a department needs to take out an insurance policy when an insurance policy already exists. They may think, okay, well, I didn't know that that insurance policy existed. Well, the ERM library helps you know what insurance policies are out there. Create it once, share it across all lines. Can controls be isolated, consolidated? If there is an insurance policy for a certain department, can other departments get on that policy as well so that you're not paying for 4 individual policies? Now, by insurance, I don't mean the traditional insurance. It's in some cases, yes, but is there something out there to protect them? Hold on one second. Can you link your resources to a particular process so that you don't have to keep reinventing the wheel every single time? The organizational information and the library should be divvied up into 3 areas. What resources are available? Who's using them? Who is the key department responsible for mitigating this risk? And can you formalize your dependency on those resources? Now that risks have been identified, how do you evaluate them? Does a risk affect multiple units? Well, that'll vary based on your organization, based on your industry, and based on the function of the unit. Let's take, for example, the Dodd-Frank Act. It's going to affect many different processes within a bank. So you have to consider, okay, as part of my compliance risk, here's one of the rules I have to comply with. How does this affect me? When the Affordable Health Care Act was rolled out, that affected every organization. The biggest one affected was HR. Therefore, HR was probably the one who owned that risk. But there are other departments that may have been affected as well. When the risk is identified, are they identifying a true risk? Have they really understood and thought out the effect of this risk? If you're looking at their library and there is no cross-functioning, then they have not done an adequate job reviewing risks. They just identified the risks and picked someone to be assigned to a risk. When you are looking at the library, audit should be very concerned if any of the risk owners are TBD. If any of the risk owners are named, it should be a department and it should be a position within that department. How many key risks are being mitigated? What is the universal tolerance? You can't have a different tolerance for each department. There has to be a universal tolerance because enterprise risk management is based on the risk to the entire organization, not to the department. And how many key risks are being monitored? That number should change year to year. It should increase. As they become more efficient and more effective at their job, they should be able to monitor for more key risks. How mature or evolved is your ERM process? ERM is a process. ERM will not tell you it is a process. They think it's more of a art. But no, it is a process. They need formal policies and procedures. They need to have some sort of risk leader. Usually that risk leader is what we call a CRO, or Chief Risk Officer. Have they identified any risks that would inhibit achievement of strategic objectives? Granted, you can't foresee all risks. There may be an earthquake that wipes out your corporate headquarters. Is that foreseeable? No. Is it a foreseeable risk if you're in an area such as Japan? Absolutely. Is it a foreseeable risk if you're in California? Absolutely. Is it a foreseeable risk if you're in, I'll use New Jersey because that's where I'm from. We very rarely have an earthquake. It's really not foreseeable for us, but if there have been changes and there have been more earthquakes in the area, now that risk needs to be elevated on the risk library as to, there was a low chance of it happening before, now there's a medium chance, now there's a high chance, whatever the case may be. Has the board reviewed the ERM policies, their charter, their strategy, whatever the case may be, and signed off on it? ERM can't just operate based on their own autonomy. There has to be buy-in from the board that, yes, this is the way I want you to function. Has risk management been aligned with business practices? It's part of your day-to-day strategy making. On a daily basis, our employees make for us millions of decisions. They have to understand that each decision comes with a risk. What are those risks and what is going to be the effect on my decision? I don't care who it is in the organization, they make a decision and they make a decision that's going to affect you. I'll give you this example. There was an employee who worked for McDonald's. Firefighters came to his house in the morning. Those firefighters later showed up for lunch at the McDonald's. He decided to treat them. Nice thing to do. Seemed like the right thing to do. It was against corporate policy for whatever the reason was, and he was eventually fired. McDonald's now has a reputational risk because that information about him getting fired went viral. We live in an age of constant communication. If there's anyone on the line who's never heard of social media, such as Facebook, Twitter, LinkedIn, you may have 1, 2, 3, 4 accounts for all of these. We live in an environment where every time, if someone makes the wrong decision, it is going to have a major impact on us. Has ERM considered that? They have what's called a RIMS risk maturity model. It's an umbrella framework. It's not by any means required in the organization, though it is almost seen as the holy grail of ERM, that will evaluate where ERM is and how mature they are. It won't tell you, yes, there are no control weaknesses. This is the perfect ERM model. Everything's working accordingly. But what it will tell you as an auditor is, yes, we've grown from the last time we've looked at it. How do you use it? It's software that you install, and it looks at 7 attributes, 25 factors, and many underlying competencies under that to come up with a score as to how mature you are. Those attributes. Are you getting the degree of executive support that your ERM team should have? Is there an ERM process management, for example, formalized written policies and procedures? Is there a risk appetite management? Is there a root cause discipline? Many times I'm called in to audit a project for one very important reason. They're trying to find a root cause as to why the project didn't go the way it was expected. Same thing with ERM. Things did not go as expected. Tell me why. They want ERM to uncover new and emerging risks. Are they doing some sort of performance management? Are they able to sustain resiliency and sustainability? And we'll talk about those 2 factors in a little bit. As far as degree of executive support, if they are aligned to the point where there is a chief risk officer, the chief risk officer, is he reporting operational risk priorities to the board of directors or some sort of oversight group? I worked with an organization where it was a worldwide organization, and what they did is each location reported up to their board of directors, which was great, but then there was an oversight committee to see how all the different locations were functioning within ERM. That then rolled up to another committee, and then finally to corporate's overall board of directors. They couldn't rely on each location saying, yes, this is good, because a risk identified in another location may still affect, let's say, Brazil. So this oversight committee was making sure all the companies and all the locations were functioning within the same library, even though it was tailored for their location. Are they performing qualitative risk assessments? Qualitative risk assessments can be overused. We don't want a qualitative risk assessment, but for big decisions, you should see a qualitative risk assessment. If you're not sure the difference between a qualitative and a quantitative risk assessment, quantitative risk assessment is what audit uses. That's where they assess it as a high risk, a medium risk, a low risk. Qualitative risk assessments are those that give it a score, such as Monte Carlo simulations. It's something I may use when building a building to say, okay, we want to build a 150-story skyscraper in the middle of Japan. Will it sustain an earthquake? I don't have the answer to that, but I could put it through engineering scenarios to come up with an answer to that. Is risk management competency part of their performance review? Process and risk owners use ERM. Do they? Or do they have access to the ERM library? Are there regular planning cycles between back office and ERM to go over the risks for that area to go over overall risk and to see if there are others that they should be working on. Our process is defined and our process risks identified. Our risk issues and variances communicated and acted upon in a timely manner. Does frontline support the process owner? Are they continuously doing and conducting a risk assessment? Has every business process gone through a formal risk assessment? And are risk management issues clearly understood at all levels? Again, considering the fact that even someone who just answers the phone for you is putting the organization at risk and needs to understand that. Business units and departments can create, evaluate future and far-sighted scenarios. They need to say, okay, if this doesn't work, what could go wrong? And what do I need to make it right? It should be considered for a 12-month time period. However, if there are dynamic changes or major events going on in your world, you need to look past that 12 months. Qatar and World Cup, Brazil and World Cup, any area that's holding an Olympics soon. If they're doing a project related to that Olympics, are they looking into the risks around that project as well? Understanding that as a project is done, the risk that it's subject to changes. Is there an ERM program? Have all operational managers been able to give feedback into the ERM process? Is it fairly distributed across the organization based on some sort of method? Does it state that, accounts payable needs to be audited every 3 months? If so, why? Why are you picking on accounts payable? Well, look, they're a critical risk area because of A, B, C, and D. Okay, fine, I understand that, so yes, we agree with you, it should be done. Well, why do you want accounts payable to be audited every 3 months? Well, because, I know the former manager of that area, and him and I just don't get along. That's not a valid reason. There needs to be a clearly defined reason for participation and accountability. Is risk management accountability woven into all processes? Do you have a clearly defined risk culture? What risks are you willing to accept? How risky an organization are we going to be? Are ERM process steps shared amongst the entire organization so everyone knows what the steps are to notify ERM of new risks, of new emerging risks, of changes that may require ERM to go in and investigate? Is there a risk management reporting structure set up that says, this is what they need to report, this is who they need to report it to, this is the format it needs to take? Have they established what we call RAM, or risk appetite management? Risk appetite management means they're looking at risk. They know what risk tolerance is, they've assessed actual risk, they're willing to put controls in place. But the risk tolerance is going to tell them if the controls cost more than the risk exposure, don't do it. Portfolio views are very dynamic. They're changing. How are you able to see those views? Is risk information categorized, analyzed, and have all dependencies to that risk been addressed? Is the risk tolerance formally defined? The risk tolerance may be we accept variances no greater than 13% or no greater than 15%, whatever the case may be, whatever the tolerance is within that organization. Risk-benefit trade-off. This is what we expected, or this is what we assessed, and this is what we actually faced. This was our expected effect. Here's our variance. Does that fall within our risk tolerance? Give you an example of risk tolerance. It used to be a big buzzword that, the company was going to comply with Six Sigma. What did that mean? That meant that 99.996% of the time, which came out to, I think, half a standard deviation or something like that, we were going to be perfect. Can we expect perfection? No. We understand variances are going to be happen. What is our tolerance for the number of variances we're going to get? Resource allocations. What are your resources within an organization? People, systems, cash. When they're allocated, is there some sort of priority basis that they go on as to what resources will go where? And is that allocation clearly defined somewhere, usually within the ERM framework, as to how it's going to happen? Your risk benefit. Your benefit for accepting a risk is going to guide your action now and in the future. If we're willing to accept this now, are we always going to accept this, or are we going to change that tolerance over time and tighten it up until we hit perfection? Understanding that when we look at risk, we're looking at risk from two aspects. The negative is risk. The positive is opportunity. ERM doesn't look at one side of that. Even though they're called ERM, they are looking at risk, they are looking at opportunity. They're looking for ways to grow within the organization. How are they doing this? Are they understanding where variances are coming from? Are they performing scenario analysis to see what may happen? Scenario analysis might be, okay, when you decided to take this class today, what was the risk of taking it? Well, the risk of taking it was that you'd be away from your desk for an hour. What was the benefit? The benefit would be you'd be such an expert in enterprise risk management, you could go back and run the show. What was the expectation? Well, the expectation was I get my 1 hour of CPE, and that gets me closer to compliance for the year. Whatever the case is, how are we determining the cause? How are we determining the effect? And what the overall effect is going to be to the organization? Has root cause been considered? We can say, yes, there were variances, but that doesn't fix the problem. We have to come up with, we had variances, here's why. Here's our options as to what we can do to fix it in the future. Well, one of the options may be that we invest in a new software system. And that software system costs about $3 million. Our variances for the year were $800,000. Does it still pay to get that software system so we can make more accurate predictions? Not if I'm paying $3 million for it, it may not. But if the long run value is there, then maybe it does. Understand the chain. Okay, well, we put this system in place. Not only is it going to help us come up with better assumptions, it will help our pricing department better price out our goods. It will help our marketing department do this. It will help HR do this. But understand where that domino is going to fall once we have it set up. An incident is an unexplainable variance. Have we traced it back to a cause? If we did not meet our sales quota, why? Well, we had turnover in the sales department. We lost 6 key salespeople. Well, we're BP. We had an oil spill. Have we determined what that actual cause is? And have we determined consequences as to what's going to happen to prevent that cause again? Once you have that cause, that's what's going to help you build a library. Consistently investigate and classify any variances and classify it within risk information. Well, there was a shift in market. Well, then that's a market risk. Jot that one down, add it to the library. Here's the risks we are exposed to. Here are the consequences. Here's what we can do to mitigate this risk. Document and monitor any goals along the way to identify the cause and to correct it. Monitor operational risk. Okay, yeah, there's market risk, so let's see, that affects strategic objectives. Does it affect us anywhere else? Well, yes, it does, because this department can't operate on a day-to-day basis without factoring in this risk. And again, understand that everything changes on a day-to-day basis and that we can't expect the same results all the time. How is information collected? How is this disseminated out to the business units? Do they get a monthly spreadsheet? Is there a database somewhere that they can go to? How are you spreading that information out to all departments that need it? Again, does the cost exceed the benefit derived from it when you're coming up with a remedy? Does the information address specific risks? Is it easy to implement? Can it provide benefit in other areas? Can it be used again? Identifying opportunities. Adverse activities are opportunities. You may think significant snowfall in an area above and beyond norm is a risk. Well, for some, it's an opportunity. Who's it an opportunity for? Those who sell brining equipment, those who sell road salt, the guys who are working overtime to clean the roads and now can turn that excess income into consumer spending. Those are opportunities we need to realize are happening. We need to seize whichever way we can. Follow-up reporting, managing of risks and opportunities. Once we have the risk, how are we analyzing it to ensure that a risk that was dormant before isn't now an emerging risk? And identifying the business owners who share responsibility for that risk. Communication of goals. Does everyone know their accountability within the matrix? Are these goals built into their performance measures, into their annual performance reviews? Are we allocating resources based on impact, timing, assurance? Do the resources we're allocating to have the information they need to mitigate risk accordingly? Do they have the training budgets they need to train their staff in new compliance changes? Do they have the system support they need? Do they have the information they need? Do they have access to legal to help them explain impacts to them? Again, ERM is considered during all strategy and all planning meetings. Deviations are measured, they're investigated, they're monitored, they're reported upon. Resiliency and sustainability. Resiliency says risk happens. If it happens, can I bounce back from it? Use Hurricane Sandy as an example. Again, New Jersey's not a place that experiences many hurricanes. If a hurricane were to hit my organization, can we bounce back? Can we be operational in a day or two? Will it take 3 days or 4 days? Can I survive if it does take me 3 days or 4 days? What kind of cash float do I have where I can afford to lose income for 3 or 4 days? If I'm a hospital and I'm down for 3 days, that's going to have a major effect. Whereas if I'm a pizza joint and I'm down for 3 days, it may not have as much of an effect. Sustainability is, okay, I can rebound, I can recover to where I was before, and I can maintain that level within the organization. Not within the organization, within my competition, within my industry or trade. Resiliency comes into play during the operational planning phase. Quarterly deliverables, response procedures for deviations, and resiliency is considered during every aspect of operational planning. Disaster recovery is one example of resiliency. I remember years ago we always had to do disaster recovery audits. Is each line of business able to recover and become operational within 24 hours? Understanding the consequences if we can't. Do we need to invest in continuity planning? Do we need to have warm sites? Do we need to have hot sites? Do we need to give our employees access to work from home? Business units need to report on any internal weaknesses and how that's going to affect any threats or risks heading our way. Internal weakness. We just realize that a manager and director are in collusion. What kind of threats does that elevate? Reputation? Fraud risk? They have been fired. We are going to replace them. Here's the risk we are going to face before we can replace them. Morale has changed in the area. We're now short-staffed. We have others who need to step in and do the managerial roles that the staff alone couldn't do. What can we as an organization recover from? Can we recover from a stock market crash? Can we recover from a class action lawsuit? If so, how much? The challenges facing internal audit is that the velocity and the complexity of risk is changing. And it's changing to the point where it's becoming increasingly complex. Creative accounting schemes, such as mortgage loan swaps. We all know what happened there. It's called the housing market crisis. Complexity of new markets. New products that come out that aren't fully understood. Expansion of risk management at the enterprise and line of business. Not for nothing, but this is a change that internal audit may not be used to. New rules and regulations. How often do rules and regulations change? Once a decade? No. They change on a monthly basis, on a weekly basis, on a daily basis. President Obama came out yesterday and said that, those who enroll in community college will get the first 2 years free. May not be a risk to most of us, but consider the risk to higher education. Is it going to have a downward impact on them? Absolutely. Are they going to need to rethink their strategies? Absolutely. Are they going to need to think of new ways to attract students, to possibly keep their grants, etc.? Yes. And when a judgment call is made, audit can't audit a judgment. They can only state that based on information received, a reasonable person should have come up with the same judgment call. What should internal audit do? How do they get involved? Review management of key risks. Are they looking for key risks at a new time? The risks that they're coming up with, do they make sense within the organization? Do they make sense for the trade? Evaluate how key risks are reported on. Evaluate the process. What do we do now that we have a new risk? Do we just sit back and wait until it becomes an issue? No. Provide assurance that risks are evaluated correctly. Let's face it, internal audit knows the risks. They should be providing some sort of assurance that, yes, you have identified all the risks. They cannot go back to ERM and go, these are additional risks I want you to include. But they can coach ERM to say, have you considered this? And let ERM come to that decision on their own. They can't force a risk on ERM, but ERM can be helped to come up with that answer. Coaching management in response to risk. ERM cannot own risk. Internal audit cannot own risk. Management has to come up with a response on their own and become accountable for it. Facilitate identification and evaluation of risks. Hey, we've looked at this department before, and here's some of the risks we came up with. Measure their compliance to formal processes, to anything that's written, to any directions from the board of directors, to ensure that they're following it. Definitions aren't established. There are definitions established by COSO, the Committee on Sponsoring Organizations. COSO is who audit reports up to. Looking at standards that are defined, such as ISO. ISO is a bunch of standards that are out there, and people think it's an assurance that if someone's ISO compliant, that must mean they are ready to face the challenges and that they have done everything they need to do. Well, an ISO standard is basically, to be compliant with an ISO standard, it means you submitted something in writing to the ISO committee that says, yes, we're ready for this, or yes, we have policies and procedures for this. It doesn't assess your degree of readiness. So, internal audit has to determine that definitions were established. There is a standard out there. Effectiveness measures have to be built into that definition. Yes, we want to continue to improve, and this is what we expect in future years. What we expect in future years, is it realistic? Maybe. Let's take, for example, mobile phones. Not cell phones and not smartphones. You know those ones you have to plug into a car charger? Can you inspect that sales for mobile phones will go up 20% next year? No, why? It's a saturated market, and it's already been replaced by substitute products. Definitions need to be communicated to ERM. Get their buy-in from it. Have them formalize the definitions. How do you measure effectiveness or ineffectiveness, for that matter? What standards do you use and why? Do you use COSO? Do you use ISO? Do you use others that are out there? How do you measure improvements over time, and how do you continue to improve? Are the standards too lengthy and abstract so that the reasonable person has a hard time following them, understanding them, and applying them to their job? What else can audit do? They can become a champion. A champion to facilitate the need for ERM. Hey, we don't have ERM in the organization yet. We need it. We need someone to take control and look for these risks for us. They can't be ERM. All they can do is facilitate, coordinate, educate the board of directors as to the need, integrate what they already know about the organization to ERM so ERM can decide the overall organizational impact. Collect risk, collect information, and share it. Do they share it to ERM? Expand their audit universe. Hey, this is what ERM has as a risk. How does that affect me? This is what I have as a finding for this department. Is it really significant? It may be significant for the department, but how does it affect our enterprise risk? Here's a finding. Here's an investigation. Here's a control weakness. Let me report this up to ERM so that they can change their focus. Focus more broadly on enterprise risk. Get buy-in from enterprise risk to your audit universe. Link internal audit reporting to those critical risks that ERM has identified. If it's not a critical risk and you have limited internal audit resources, you really need to be focusing your resources to those critical risks. Compare internal audit risks to those reported by ERM. Where are the synergies? Where are the differences? Are we focusing operationally where we should be? And be on the lookout for any emerging risks, either identified by internal audit or by ERM that, hey, wait, this was lying dormant for a while. We need to focus on this now and see what do we need to do. There are also what we call black swans. Every organization is eventually going to be hit by a black swan. And yes, I was told by a former student that this is not actually a swan, but bear with me. It's those risks or opportunities that can't be predicted. They're rare. They do have a high impact. So we may not consider them with ERM, but we should somehow have it considered and factored in to our resiliency plans and our sustainability plans. There are also transforming events. Those risks that we can take and transform into some sort of results. Those that we can enhance our risk strategy, develop a reactive strategy, talk about it with our external stakeholders, and figure out what we can do. There are two clients that I mentioned here, and they wish to remain confidential, but BM was an organization that was faced with possible bankruptcy because of industry changes that he was facing. He was a contractor for UM. said, okay, we are an external stakeholder. It is important for us that you stay financially solvent. If you can't, come to us, we'll lend you the money. Embed risk management into all your thresholds and communicate your risk coverage through some sort of dashboards or reporting. Integrate wherever possible, strategy setting, annual business planning, budgeting, M&A targets. ERM and audit should be husband and wife. I actually have talked to many executives and many risk managers who actually use this analogy, and I love it. They actually say there should be some sort of marriage between audit and ERM. Why? So you can divide and conquer and focus where you need to focus. You're still reporting to different people, but guess what? So is a husband and a wife. A husband is reporting to his parents, a wife is reporting to her parents. They understand the different roles. They understand that there are limitations within their roles. With a husband and wife, if you want to expand the family, can you ask the husband to have children? Not really. Be faithful to one another. Communicate. And if all fails, communicate again. And that'll be a key to making internal audit and ERM work more effectively together and create the synergies you want. Our risk management efforts mire down into minutia. Are there gaps in accountability? Is there a lack of a tone on top conducive to risk management strategy? Is anyone making higher than expected returns and nobody understands why? Should it be investigated? Absolutely. Is the board engaged with key decisions and on a timely basis? Is risk an afterthought to strategy setting? It should be, but it should also be a before thought. Before we take on this strategy, we have to know what's going to happen in the long run. And then complete the ERM risk assessment and tie it back to your audit plan. Are you looking at the critical risks? Are you prioritizing risks the same way? Are you reporting on your risk reports up to ERM? Any infrastructure deficiencies, any control weaknesses, and any recommendations and improvements that management may want coming down the line. And that's it.
Thank you so much, Denise, for the wonderful presentation. I also would like to thank all our participants for cooperating with us. It's time now for the question and answer session. In case any of you have any questions, please feel free to click on the raise hand icon, which is at the bottom of your participants panel, and I can unmute your lines and you can ask your questions verbally. Or you can also go ahead and post your questions on the Q&A panel or my chat box, and I can have them passed over to the presenter to have them answered. In the meanwhile, I would sincerely request you to share your feedback with us. The feedback form has about 8 questions, mostly multiple choice in nature, and wouldn't take more than 2 minutes to complete. The feedback form will appear on your polling panel right now. It would be open till the end of the session. Well, ladies and gentlemen, just wanted to remind you that it's time for the Q&A session now. In case you have any questions, please feel free to go ahead and ask your questions. You can either click the palm-like icon at the bottom of your participants panel to ask your questions verbally, or post your questions on my chat box or the Q&A panel. While we're waiting for some questions to come up, I would like to inform all our participants that in case you, your friends or colleagues find this webinar useful and would like to purchase the recorded format, you can give us a call at our toll-free number 1-800-447-9407, or you can also log into our website, that is www.complianceforall.com. Well, Denise, I don't see any questions coming up. Do you have any concluding remarks before we close today's session?
Yeah, I just want to thank everyone for dealing with my logistical issues. I'm glad my voice is able to hold out for you, even if I did have that small coughing fit halfway through. If you don't have any questions at this time and you go back to your desk and you think of something and you're like, oh, I should have asked that, it's never too late. You can either send me an email through Compliance for All, they'll know how to get in contact with me, or if you contact me at the website on the bottom of the slides, the www.auspicium.com, feel free to contact me at any time. I usually respond to emails within 2 to 3 hours.
Thank you so much, Denise. Ladies and gentlemen, we are grateful to you for taking part in today's webinar. And in case you have any questions, please do give us a call, or you can also write into us at webinars@complianceforall.com. Well, we value your feedback. Please do give us your feedback on the feedback form. It will be open till the end of the session, and whatever your training requirement is, whether it's online or on-site, it would be our priority. Well, at this point of time, I would like to thank all our participants on behalf of Dennis and also the Compliance for All team for having taken part. We look forward to having you with us again sometime soon for your continued patience. Thank you so much, Denise, for the wonderful presentation.